everyone, we are Group 83, and today I will present the first part of a report, which is the AI-assisted investment analysis for Coast Group. To begin with, our group used OpenAI ChatGPT, specifically GPT 5.5, to generate a preliminary investment analysis based on publicly available information such as Coast financial performance, dividend history, market position, and industry outlook. After analyzing this information, the AI provided an initial investment recommendation of hold. The AI identified several strengths of Coast Group, including its stable revenue growth, strong position with the Australian supermarket industry, and consistent dividend payment. Since Coast operates in the consumer staple sector, the business is considered relatively defensive because demand for groceries and household essentials remains stable even during weaker economic conditions. However, the AI also identified several important risks. These include increasing competition from retailers such as Aldi and Costco, raising operating and supply chain costs, as well as growing regulatory pressure within the supermarket industry. The AI suggested that these factors may limit Co's long-term growth potential. Our group then used interactive promoting of further refine the AI analysis. For example, we asked the AI to reevaluate Co's under stronger industry competition and assess the sustainability of the company's future dividend payments. Although the AI-generated analysis provides a useful starting point, we found that many responses remained relatively broad and qualitative. As a result, our group conducted additional independent financial analysis, including CAPM and dividend discount model valuation techniques, to verify and refine the AI recommendation.
The Australian supermarket industry is widely considered a duopoly, dominated by Coles Group and Woolworths Group. Together, these companies control around 65% of Australia's grocery retail market, alongside competitors such as Aldi and IGA. This creates a highly concentrated industry with strong barriers to entry and relatively low revenue volatility. Because food and household essentials are non-discretionary products, supermarkets are generally protected from major economic downturns. Even when consumer spending weakens, people still need groceries and basic household goods. However, not all supermarket products are equally defensive. Discretionary items such as alcohol, luxury foods, and prepared meals are more sensitive to changes in household income and consumer confidence. Recent economic data showed that Australian consumer spending grew only by 0.6% in January 2026, highlighting a weaker domestic demand and pressure on higher margin discretionary products. One of the biggest opportunities shaping the industry today is the rapid expansion of e-commerce. Online supermarket sales reached approximately $4.5 billion in 2025 financial year, growing more than 24% from the previous year. Online shopping and click and collect services are becoming increasingly popular, with many Australians combining online convenience and in-store purchasing. To support this shift, supermarkets are investing heavily in consumer fulfillment centres and automated distribution centres. Despite this growth, around 90% of supermarket revenue still comes from physical stores, meaning the future of the industry is likely to involve a hybrid model that combines digital convenience and the traditional in-store shopping experience. Another major opportunity is the expansion of private label or home brand products. Analysts believe there is significant potential for supermarkets to increase profitability by developing premium home brand ranges in areas such as fresh food, bakery, health, and household products. International markets, particularly in Europe and the United Kingdom, have demonstrated how successful private label strategies can strengthen consumer loyalty and improve margins.
Despite these opportunities, the industry also faces major challenges. Concerns about market concentration and pricing protects have increased the government security of supermarkets in recent years. Both Coles Group and Woolworths Group have faced criticism and legal action from the Australian Competition and Consumer Commissions over misleading price protects and supply treatment. Public trust in the major supermarket has declined sharply, with both companies ranking among Australia's most distressed brands. From July 2026, new government regulations tackling the excess price growing except to increase oversight and strengthen penalties. However, analysts still agree that profitability and reliance of the supermarket industry reduce the long-term threats posed by fines and regulatory pressure. Competition is also increasing from discount retailers such as ALDL and Costco, which continue to attract price-sensitive consumers. More Australia are now cross-shopping between the multiple retailers instead of competing or purchase at one supermarket. This trend places downward pressure on price and reduce customer loyalty towards major supermarket chains. Turning specifically to Coast Group, the company generates over $4 billion in revenue in FY 2025 and operates more than 1,800 retail outlets nationally. Supermarkets account for almost 90% of total revenue, while liquor retailing and online sales also make important contribution. One of Coast's strongest growth drivers has been e-commerce, with online sales increasing by over 24% in FY 2025. Investments in automated distribution and fulfillment centers have helps reduce delivery costs and improve the operation efficiency. And at the same time, Coast achieved over $327 million in cost savings through the automation and program efficiency programs. Finally, strong corporate governance is important in reduce urgency problems between the management and shareholders. Coast Group use an independent board structures, performance-based executive remunerations, and oversight from major institutions, investors to maintain the accountabilities and align management decision with long-term shareholders.
Now I will explain our valuation of Coast Group. We used a two-stage dividend discount model, or DDM, to estimate Coast's intrinsic value. This method is suitable because Coast is a mature company and has a stable dividend history. First, we calculated the cost of equity using CAPM. We used the Australian 10-year government bond yield as the risk-free rate, which was 4.96%. We used cost beta of 0.29. This beta is quite low because cost sells daily essentials such as food and household products. Even when the company is weak, people still need to buy these products. We also used a market risk premium of 5%. Based on these inputs, the cost of equity is 6.41%. Next, we estimate dividend growth. Since Coast is already a mature business, we did not assume high growth. We used a short-term dividend growth rate of 3% of the next 3 years. After that, we used a long-term growth rate of 2.5%. For dividends, we used FY 2026 as the base year. Coast paid a 41-cent interim dividend in the first half of FY 2026. We combined this with the most recent final dividend of 32 cents. So the estimate 4-year dividend is 73 cents per share. Using the DDM model, we estimate Coast's intrinsic value to be about 19.41 per share. At the valuation date, Coast market price was $21.51. This means the market price was about 9.8 cents higher than our estimate value. Therefore, our recommendation is hold. Coast seems slightly overvalued, but not enough for a strong sale recommendation. The company is still stable and pays regular dividends. Exciting investors may continue holding the stock, while new investors may wait for a lower price. Overall, our valuation was a hold recommendation.
Our group's final recommendation for Coast Group is hold. Using the Tuesday dividend discount model, we estimated that the intrinsic value of the Coast shares at approximately $19.41 per share, compared with the market price of $21.41 on 20th of May 2026. The stock appears to be slightly overvalued by around 9.8%. As this indicates limited upside potential, the difference is not large enough to support a sale recommendation. Coast remains a strong defensive company with the Australian supermarket industry. The company benefits from stable demand for essential grocery products, reliable cash flows, and a consistent dividend history. These factors make Coles attractive to investors seeking stable income and relatively low investment risk. In addition, Coles continues investing in e-commerce, supply chain automation, and private label products, which may support future operational efficiency and moderate long-term growth. However, the company also faces several challenges: increasing competition from retailers such as Aldi and Costco's, raising labor and supply chain costs, and growing regulatory pressure on supermarket pricing may limit future profitability and growth opportunities. Overall, while Coles offers strong defensive characteristics and stable dividends income, the current market price limits its growth potential. Therefore, our final investment recommendation is hold. During the project, our group used ChatGPT to assist with the preliminary investment analysis. AI was useful because it quickly summarized the publicly available information and helped identify important industry trends, company strengths, and potential risks. It also improved the efficiency of our research process and provided a useful starting point for future analysis. However, we also identified several limitations. The AI-generated responses were often broad and qualitative, especially when discussing valuation assumption, competition, and the long-term growth prospects. AI could not fully justify important financial assumptions such as discount rates or growth rate with detailed financial evidence. Overall, this project demonstrates that AI can be a valuable support tool in financial analysis, but it should complement rather than replace independent research and critical human evaluation. So that's all for our presentation. Thank you.